I'm Scott Starratt with Starratt Wealth Management, a part of Canaccord Genuity Wealth Management. So today's interview is a fellow by the name of Sandy Liang. And Sandy has over 30 years experience with credit and investment management. His education is BA from Western and a MBA from McGill, and he's a CFA charter holder. Now, the interesting thing about Sandy is he has so many rewards under his belt that I won't list them all here, but needless to say, he's definitely an award-winning money manager. Everything from Lipper Award winning to Canadian hedge fund awards, name it, he has it. And his history was about spending about 13 years on Wall Street on the fixed income trading side of things with Cobalt Asset Management and as a senior managing director at Bear Stearns, which I'm going to come back to later in the conversation because I have a question about that. But without further ado, Sandy, how's it going?
Doing well, Scott. Thank you for having me.
Good, thanks. So let's get right to it. I mean, one of the things that I found with you is that you have a little bit of an interesting trajectory as it applies to your career, and some of which I just listed there. But how did you get started in managing money?
Sure. Thanks, Scott. So as you mentioned, I've been in the business roughly 30 years, but for the first 2/3, I was an analyst. So I was a publishing analyst, meeting with companies and getting to know companies and industries, the research reports that you get with sometimes stock charts, sometimes bond charts. And I spent 8 years at Bear Stearns doing that, where I was a senior managing director and promoted to partner. And then the credit crisis happened. So I was working in New York, and that week in March 2008, I happened to be in Florida on vacation with my family, and there were a lot of news items regarding Bear Stearns and, quote, liquidity and run on the bank. And through the course of that 1 week vacation, I got there on a Wednesday, and by the Sunday it was all over. We were sold to JP Morgan for $2 a share. So that was the end of Bear Stearns. And at the time, the credit crisis hadn't really started yet. And so for all of us at Bear, we were still in demand as professionals in New York. And I was considering my options that spring, and I was going to go do the same job with a European bank. But then I got an offer from a hedge fund in New York named Cobalt Capital, run by a guy named Wayne Cooperman, who him and his father have both been in the business a long time, great track records, billionaires. So I went to work with Wayne in September 2008, and that was a week before Lehman had its issues. And Bear didn't declare bankruptcy. Lehman actually did declare bankruptcy. But long story short, that's how I got into money management. I started at Cobalt Capital the week before Lehman and had a trial by fire through fall 2008 and really through 2009 as well.
Wow. So needless to say, you learned a lot during that time about credit and the credit, the world of credit as it applies to what they refer to as a black swan event. In other words, an event that is so extraordinary that it has a special name to it.
Yeah, black swan event. And I think that the more the relevant word for the 2008 experience was really dislocation, because the head PM at Cobalt used that word a lot. Dislocation means things are in disarray and things are not naturally where they should be. So if you're in the business and you do your homework and you sift through the dislocation, that's really where the opportunity is. And in the course of one's lifetime in the business, you'll see a number of dislocations. I would characterize 1998, the Russian crisis, as a dislocation. I think tech wreck was a dislocation, and certainly early 2020, the pandemic and the credit crisis, of course.
Right. Okay. So one of the things that I've been impressed with about yourself has been, you often say that, well, you have these credit managers that, know how to predict interest rates or think they know how to predict interest rates, at some level of success or, like you say, look at a balance sheet of a company. But, you go a little bit deeper. You actually look, at the legalese, at the covenants and things like that of a lot of these bonds. And I think you're relatively unique in that way. One of the stories I still tell clients, see, I'm going to take control here. One of the stories I tell clients is the time when you emailed me at 8:30 at night, Calgary time, with the headline that one of your major holdings went bankrupt. And of course, scared the hell out of me because basically I was like, oh no, this is a major position. But you had read the covenants of this particular bond so well that you didn't buy the bonds that necessarily went to default, but you bought the senior bonds that everybody got
Yes.
paid out from. So
Yes.
that in itself, that must be a big win in your world when you can pull off something like that.
Yeah, bankruptcy is interesting because I know that there's a fairly higher profile money manager in Canada, call it 10, 15 years ago, who used to talk about, I've never had a default in my portfolio, but, the way we think about credit is you got to think about the whole capital structure. When I say the whole capital structure, I mean, the bank loan that's often secured or the bonds that may be secured, and then you have unsecured debt, and then sometimes you have preferred equity and then the equity. So you have to think about the whole capital structure and the relationship, the relative value, because often if one part of the capital structure is in trouble, that's very good for other parts. And there's some very well-known examples. I mean, obviously, as a firm, we've been through many, but in coming out of the credit crisis, I'll give you an example. There's a shopping mall company that was subsequently bought by Brookfield, and it's called GGP, General Growth Properties. And it was a pretty large mall company that actually went bankrupt in the credit crisis. But the thing about the credit crisis is that it lasted roughly a year. The bankruptcy lasted more than a year. So by the end of the bankruptcy process, it was apparent that the equity that had gone to, under a dollar still had value. So anyone who bought that equity coming out of the bankruptcy, really did very well, including Brookfield, who were often the smartest guys in the room. So you really have to think holistically about the different parts of the capital structure of the company, and the interaction, the valuation, and where really you get the best risk reward. Because ultimately, that's how we think about our investments. It's almost analogous to playing poker. It's risk reward. What are you getting? What's your possible upside, and what's your downside risk? And that's really how we approach every company.
So kind of, in other words, you're saying, you by the time you do all the work and understand the company and understand what the company's about, you're just going to buy, in some cases, in this particular fund that we own with you, which is the Credit Opportunities Fund, you're going to potentially buy some of the equity if you think that the equity offers a much better risk reward than the bonds, for example.
Yeah, I mean, every once in a while we do that. I would say the core of our return or alpha generation is in credit, and it's in the debt, because the debt is more predictable. You lend money and you get the money back plus coupon or interest rate over time. But every once in a while you find a situation where the equity is the most attractive part of the capital structure because of some assumptions possibly made by investors that when you look at the whole cap structure, you see them to not be true. And one of the best known examples of that in Canada is Air Canada. I mean, Air Canada common equity in circa 2012 traded at $1, and it traded at $1 because everyone thought the airline was going bankrupt, and everyone thought that because the company itself had a ton of debt, and American Airlines had just been bankrupt in the States. So you put two and two together, it's like, oh my gosh, these guys must be going bankrupt. But if you looked at the capital structure at the time, you realize that so much of Air Canada's debt was pension obligation. And even though there's debt on the balance sheet, it's not a near-term maturity. So, that's a situation where we've been involved in Air Canada debt for a long time. At the time, we did a lot of work on Air Canada debt, and we found the equity because it just seemed like the assumptions about that piece of paper by the market were unfounded.
Right. Okay. Now, in the portfolios that you're managing, do you use leverage or privates in the models?
So we don't, Scott. In fact, we kind of do the opposite, where we normally have a pretty high cash balance. So we're not just unlevered, but we're even less levered because we keep a lot of cash on hand. And I wouldn't say it's unique, but it's kind of an investment style in credit where we don't see ourselves as risk amplifiers. I think that the way we approach risk is the way you limit your risk or maximize your risk reward is really to do your homework on the companies you're involved in, and we don't think a blanket strategy of buying a lot of high quality debt and then amplifying the risk so the whole portfolio has a lesser quality. That's not really how we add value. And you mentioned privates. Privates are debt pieces of paper that don't actually trade every day, and they're called privates because it's kind of like a private club where on one piece of paper maybe there's only 2 or 3 investors, and so the paper never trades. We're not in that business either. We have a liquid alt portfolio where we provide daily liquidity to our investors, and so because of that, pretty much everything in our fund, if it doesn't trade every day, at least there's a market coming from a pretty reputable underwriter.
Okay. Are there any external risks that you see out there that would change your ability to run the strategy?
That's a good question because I know that there's a lot of kind of very complicated strategies out there where you don't really, know the full risks until things go wrong. And I would say that structurally, what we do is actually pretty simple. We are investors, and we're net long, which means that even though we do short some things, we're much more long than short, and that's how we grow your capital over time. And when we do short things, we often, I know that there's a pretty high profile case in the news lately, which is GameStop, which is, a situation where a hedge fund manager in the States shorted a stock that was under $10, thinking that the company was going bankrupt, and the stock ended up going to, I don't know, $350. I mean, that must have been pretty painful. But when we do short things, a lot of times they're ETFs. So you by definition, you can't really short squeeze an ETF. And you will never see us shorting a, $7, $8 stock. So
Right.
you can sleep at night knowing that.
Right. Going back to the Bear Stearns part again, and being on what we would refer to as the sell side, meaning you're talking to portfolio managers every day and trying to, I don't want to use the word convince, but trying to discuss the merits of a particular issue that you may like, or Bear Stearns may like in this case. What was the learning from that, and then moving to the other side where we refer to it as a buy side, where you're actually listening to these salespeople, so to speak,
Yes.
and analysts, did you take a lot of knowledge from one side, move into the other?
Oh, absolutely. It's hard to specifically say that this is the lesson, but when you're an analyst on the sell side, you're in the business of getting into the details. You're in the business of knowing these industries and companies better than anybody, because that's how you add value with institutional investors. So as a sell side analyst, I was based in New York, and our best clients were in New York and Boston and LA, and these are some of the largest institutional investors in the States. And we're constantly interacting with the Fidelities and the Capital Research and Management, and so over time, once you get into the details, you have an experience set where if you've been in the details and in the weeds with a number of companies and management teams over the years, then you really get a better understanding of things to look for, situations you've seen before. One of my favorite sayings right now is, yeah, we've seen this movie before. And we were counting the number of management teams. I've met with over 1,000 management teams in my career. So if you look at that experience set and multiply it by the number of people on my team, because I have 3 analysts that work with me on fixed income and credit full time, and they're not, obviously they haven't been in the business quite as long, but we have a pretty broad experience set with industries, management teams, getting into details. And if you've been in the details, then you can recognize situations from from a top-down basis when you have less information.
Okay. Okay. Cool. Well, thank you very much. Appreciate your time. That was really good. If anybody's interested in the strategy that Sandy runs, or any of the other strategies and how it might fit into an investment portfolio, please don't hesitate to reach out to us at www.starrattwealth.com. And we'd be more than happy to chat with you about this or any of the other investments or processes that we have within the team. Thank you very much.
Thanks, Scott.